Good morning, I'm Gary DeWall, and this is Bridging the Week for February 22nd to 26th, and today is February 29th, 2016. An advisory committee of the Commodity Futures Trading Commission recommended scrapping the agency's proposed new rules imposing federal position limits on energy and certain other derivatives. Meanwhile, a broker-dealer was fined $675,000 by the Financial Industry Regulatory Authority for allowing a customer to repeatedly fail to timely cover short sales involving exchange-traded funds. There was just a bit of news impacting financial services firms last week, so let's get started. A report by the Energy and Environmental Markets Advisory Committee of the Commodity Futures Trading Commission roundly criticized the CFTC's 2013 proposed rules mandating new federal position limits for energy futures, options, and swaps. According to the report, which was adopted by an 8-to-1 vote of the EMAX members, there is no evidence that the proposed rule is, quote, demonstrably necessary to prevent excessive speculation or associated fluctuations in price, end of quote, coupled with already sharp reduction of liquidity in energy derivatives because of world developments. Passage of the proposed rule would adversely impact the ability of end users to use energy derivatives for hedging, and proposed limitations on what constitutes bona fide hedging, quote, is unnecessarily restrictive and contrary to standard prudent risk management activities in energy markets, end of quote. Tyson Slocum, Energy Program Director of Public and Citizen, Inc., the one EMAC member voting against the report, wrote a dissent to the report that criticized its findings, saying that, quote, the report's claim that position limits are not necessary relies on selective presentations while ignoring other academic research showing that position limits are necessary, end of quote. Based on the findings of the report, CFTC Commissioner J. Christopher Giancarlo said, quote, the CFTC should not and need not finalize its current position limit proposal, end of quote. Wedbush Securities, Inc. agreed to pay a fine of $675,000 to the Financial Industry Regulatory Authority and NASDAQ Stock Market LLC to resolve charges brought by FINRA related to the firm's allegedly impermissible short sales on behalf of a client involving almost 300 million shares of 14 exchange-traded funds from January 1, 2010 through March 16, 2012. According to FINRA, during this time, Scout Trading LLC, a correspondent broker-dealer client of Wedbush, on multiple occasions submitted orders to Wedbush to redeem ETF shares on the primary market and to sell ETF shares in the secondary market. However, said FINRA, these transactions resulted in a substantial number of fails by Wedbush, which were allocated to Scout. Scout typically closed out its ETF fails on the 6th day following the initial trade date, known as T+6, by creating new ETF shares through placement of a creation order through Wedbush. In doing so, Scout relied on an exemption for market makers from the ordinary requirement to close out fails by the 4th day after trade date. However, according to FINRA, Scout would promptly reestablish its short position by redeeming or selling shares of the same ETF the next trading day after closed out the related ETF fail. FINRA claimed that Scout was not entitled to rely on the market maker exemption to permit T+6 cover of fails, and implied that Wedbush should not have permitted Scout to reestablish its short positions promptly afterwards. As a result, said FINRA, Wedbush violated its rule requiring all members, quote, to observe the high standards of commercial honor and just and equitable principles of trade, end of quote, because the firm did not follow up on Scout's recurring cyclical fails. The Canadian Securities Administrators published for comment a revised proposal related to the mandatory clearing of derivatives. Their initial proposal was published in February 2015. Among other things, CSA now proposes that mandatory clearing obligations only apply to participants that subscribe to the services of a regulated clearing agency for a mandatory clearable derivative, as well as their affiliated entities, and local entities with an excess of 500 billion Canadian dollar of month-end gross notional amount of outstanding over-the-counter derivatives. CSA also proposes limiting mandatory clearable derivatives to certain specifically enumerated interest rate derivatives. CSA seeks comment on its revised proposal, as well as some specific enumerated matters, including whether there might be any significant consequences that might arise from subjecting Canadian dollar-denominated interest rate swaps to mandatory clearing, quote, absent a corresponding mandate in one or more foreign jurisdictions, end of quote. Comments will be accepted through May 24th of this year. And finally, the Board of Governors of the Financial Industry Regulatory Authority approved a proposal requiring member firms to disclose to retail customers on their confirmation statements the amount of markups or markdowns for most transactions in corporate and agency debt securities. The proposal would require a firm that sells or buys a relevant fixed income security for a retail customer that on the same day buys or sells the same security as principal from another party to disclose to the customer on its confirmation statement the amount of the firm's markup or markdown from the prevailing market price for the security. The confirmation must also include a reference and hyperlink if the confirmation electronic to trade price data for the same security from FINRA's Trade Reporting and Compliance Engine, more commonly known as TRACE. Well, that's it for this week's edition of Bridging the Week. As always, there's more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. I'm Gary DeWall, and until next week, ciao.